Isn't it crazy that people check their credit score more than they check their own blood pressure? But here's the thing nobody tells you. Your credit score is not what determines whether or not you're approved for that mortgage, that credit card, that line of credit, or the loan. Because behind the scenes, lenders are looking at something completely different, something your credit report doesn't even show. First of all, my name is Alex. I'm a realtor here in Ottawa, and prior to, I was a financial advisor specializing in mortgages in one of the biggest banks in Canada. So I've seen exactly what lenders are looking for, what it takes to approve a file, and why your credit score might not be as powerful as you think. Let's start from the top. So what actually is a credit score? Your credit score is a 3-digit number between 300 and 900, created by companies like Equifax or TransUnion. It's supposed to represent how likely you are to repay borrowed money based on your payment history, credit usage, how long you've had the credit, new applications, and the types of credit that you use. So the higher the number, the more trustworthy you look on paper. But here's the problem. This number doesn't always tell the truth, and the banks are aware of this. This might seem obvious to some, but when I was an advisor, this is something I learned and I didn't even think about or didn't even consider to begin with, and it blew my mind. Someone who never uses credit, so they pay everything cash. They'll usually have a lower credit score than someone who's, has a mortgage, has credit cards, or has car loans. And when you think about that, it makes sense because your credit score is how reliable you are to repay back credit. And if you don't have much history, then how can they give you a good credit score? So if a wealthy person hasn't financed anything in 15 years, does that mean they can't get a mortgage? Of course not, because your credit score is only one part of a much bigger picture. Think of it like your GPA in school. It tells you how good you're doing in classes, but it doesn't tell anyone how successful you're going to be in the real world. Let's talk about why your score might not matter in the way you think. Your credit score doesn't tell lenders how much debt you can handle. It only tells them how well you've managed your debts in the past. That's why someone with a great credit score, like an 800 credit score or higher, can still get denied. Maybe their income doesn't support the loan they're applying for. See, the banks care far more about repayment capacity than a 3-digit number. So repayment capacity is your income, your stability, overall debt load. Now, your score does matter, just not in the way that you think. Where your credit score has the most impact is the interest rate that you'll receive, not necessarily your approval. So for example, there's a $300,000 mortgage over 25 years. Now, if you were given a 3.5% interest rate, the monthly payment is just under $1,500 a month. Now, let's say you have a much lower credit score and you were given a much higher interest rate. So let's say 6%. It jumps to just over $1,900 a month. That's over $400 more every single month just because of a lower credit score. So while your score won't automatically deny your application, it can make your payments harder to qualify for. And that's a subtle difference that most people just never realize. Real quick, by the way, over 99% of you guys watching right now are still not subscribed. If you find this video helpful in any way, or if you like this type of content, then consider hitting the like and subscribe button. It really helps me out. I would really appreciate it. That way you won't miss one of my future uploads. Truly a win-win for both of us. Let's jump back in. So let's take a look at what lenders are actually looking at. When a bank decides whether or not to lend you money, your credit score is really just the cover page. What they're really looking for is your full financial story. So your income, your current debts, your consistency, and your capacity to take on more. Here's what actually matters most when that file lands on the advisor's desk. The number one thing that lenders look at, probably the most important and influential thing that they look at, is your debt ratios. A calculation of how much of your income already goes towards debt payments and living expenses. There are two key ratios: your gross debt service, or GDS, which covers your core living expenses like your mortgage, property taxes, heating, and condo fees, or your monthly rent plus utilities, and your total debt service, or TDS, which includes everything. So car payments, credit cards, line of credit, student loans, all of it, plus your living expenses once again. And as a rule of thumb, you want your GDS under 32% and your TDS under 42% to stay safe. But ultimately what I've learned is that it's really up to your bank whether or not they want to take on your file. See, I've seen a lot of files get approved with higher debt ratios, but they had good reasons. Like they probably had a strong net worth, or they had investments maturing soon, or they just reached retirement, but they have tons of equity. Now, for insured mortgages, which are really only used in residential real estate when down payment is under 20%, CMHC allows up to 39% GDS and 44% TDS, as opposed to the 32 and 42 that I mentioned before. See, that's the point. You can have a perfect credit score and still get declined if your debt ratios don't work. The second thing lenders are looking at in depth is your employment and income stability. They don't want to just see income. They want to see reliable income. Are you full-time? Have you been consistent for at least 2 years? Or are you switching from job to job or from one industry to another? Are there gaps in your work history? If so, why? They're basically asking, can this person keep a job or a steady income stream? Because they're trying to make sure that they can be paid back, right? Even things like maternity leave are completely fine as long as you can get a letter from your employer that has a scheduled return date on that document. Then they'll consider your full working income. So again, you can have a 500 credit score and get approved as long as you're showing and proving your income and stability and good habits. The third thing lenders are looking at is your down payment and your net worth. So typically for real estate, lenders will finance up to 80% of the property's value. And that's called the loan to value ratio, or LTV. Anything above that usually requires mortgage insurance through CMHC or a private company. The larger your down payment, then the lower your loan amount, and the lower the payment is, which means the larger the loan value ratio becomes and the safer the lender feels. They feel better knowing that they likely won't incur a loss in case of repossession at an equal or greater to 80% loan to value ratio. But they're also going to take a look at your net worth, because if your net worth is negative, then they don't really have anything to secure their loan. And this is certainly true in the case of a standard loan application or a line of credit. Like if your net worth is negative, so a very common example is a student going to school. When you apply for that line of credit for whatever reason that you need it for, you'll have to make your case on how you'll be able to pay them back. Lenders are looking for good patterns, not perfection. They actually love when you pay interest. They just want to make sure that you can actually pay them. So I mean, look, while we're here, let's kill a few myths. So myth number one is checking your score lowers it. Completely false. Look, only hard credit checks will actually affect your score, especially when doing a lot of them at once. But checking yourself doesn't hurt your score. Many banking apps will even let you do this online by yourself nowadays, completely free. Myth number two, carrying a balance improves your score. False. You don't need to pay interest to look responsible. Just use your card, pay it off every month. That's simple. Myth number three, paying off debt instantly fixes your score. Not exactly, because paying off debt sometimes takes months to actually reflect on your credit score. That's why when you're applying for credit, the banks might actually ask you for proof of payment of another loan. Myth number four, closing old accounts boosts your score. That's completely false. So this is actually one of the biggest tips that I give to people is whichever credit card that you had the longest, make sure you keep it open, because the older the credit account, the older your credit age is. And that is a good thing for your credit score. Even if you don't use that credit card, just keep it open, switch to a no annual fee, and use it the bare minimum. Myth number five, income affects your credit score. It does not. The credit bureau has no idea how much money you make. It will affect your credit application, but not your credit score. Myth number six, your phone bill doesn't matter. It does now. Telecom providers are reporting your payments to the credit bureaus. So one late payment will just act like a late payment to a loan. Myth number seven, joint accounts share one credit score. No, each person has their own credit score. Shared accounts or co-signed loan appear on both credit bureaus. Let's say you had your dad co-sign on your mortgage and you missed a payment. Well, not only does your credit score go down, but so does your dad's, because he's a co-signer on the loan. Therefore, it'll show up on his credit bureau. So if your credit score isn't everything, then what should you actually focus on? Along with everything else mentioned in this video, there are three things that you need to focus on. Number one is consistency. Pay everything on time, every single time. Late payments don't just hurt your score, they crush confidence and trust with the lenders. Think of it like building a reputation. Just one missed payment will undo months of good behavior. Number two is utilization. Keep your credit usage under 30% of your limit. This shows the lender that you're in control and you're not relying on borrowed money just to survive. Low utilization says that I can handle my credit responsibly. Number 3 is financial depth. Build real financial capacity, steady income, an emergency fund, and manageable debt. This is what lenders actually pay attention to. When your profile shows stability, and your credit score naturally follows. It's a byproduct of responsible money management, but it's not the goal itself. Focus here first and the rest will take care of itself, I promise. Because at the end of the day, the bank is not just approving a number, they're approving people who will pay them back. People are chasing a higher credit score, but that's not what real financial strength looks like. The goal is not to look good to a bank. The goal is to build the kind of financial life where you don't even need their approval. Because when you have it figured out, you stop asking for permission and you start having options. So if you've been obsessed with your credit score, then zoom out. Build real financial depth, the kind that no algorithm can measure. I break down Canadian finance and real estate in plain English so you can actually use this stuff in real life. If you enjoyed this video or this type of content, then please be sure to hit the like and subscribe button. It really means the world to me. I would truly appreciate it. And with that being said, thanks for watching and I'll see you in the next one.